Please give a round of applause for Karen.
How are you guys doing? How are you guys doing today? Good? Good? Give yourself a big round of applause for coming here. Okay, so by the end of this presentation today, I'm going to teach you three main things today, okay? So because today I'm giving away some books, some very good trading books, investing books, so I'll need you to interact with me a little bit. Is that okay? Because along the way, I'm going to give you some quiz. And if you can answer this quiz correctly, okay, then you can get this book. Or this, there are three books over there. They are very good books recommended by a lot of trading gurus. Okay, so my teach you today, first thing, fundamental analysis. Now, previously in the previous seminar, how many of you came before in the previous seminar in March? Okay, a few people. I talked about global macro factors, so I'm not going to talk about that today. But mainly the main thing I'm going to talk about is central banks. Okay, so in the past few years, I've spoken in a couple of hedge fund events, and a lot of times they talk about, okay, this is quite irrelevant for us, operational efficiency. When you sit there for the half day, then you talk about operational efficiency, then it's irrelevant for you as a retail trader. But the main thing that they talk about almost every single hour, a lot of hedge fund managers, central banks. So this is what I'm going to teach you today. Okay, central banks. And also particularly monetary policy. Then the second thing, professional trading psychology. I'm going to go into this real quick. Okay, so I'm going to teach you how to think like professional and institutional traders, not just like the typical retail trader. Then at the end, I'm going to teach you a trading strategy, supply and demand trading strategy, where you can use it to increase your profits. Basically to find areas where there are unfilled institutional orders. Okay? Institutional orders, which are unfilled. Okay? Ready for the quiz? Ready for the quiz?
I think so.
Actually, not yet. I haven't started teaching it. So along the way, the quiz question will be based on the presentation. So if you can, you got a notebook. I know a lot of you bought notebooks. If you can, write down the things that are useful for you, okay? How come my slide is not moving? Wait. Okay, so the three main books. How many of you have seen this book before? What's this? A Random Walk Down Wall Street. Now, if you talk to a lot of investing gurus, trading gurus, they all recommend this book. Now, the backstory of these three books is quite interesting because last time during the pandemic, do you remember when people always say, support what? During the pandemic, there's a lot of talk about support local what? Businesses. So during normal times, I would buy books from Kinokuniya, Popular. Those are good places to buy books. But then, because that time, there was a second-hand bookstore beside my home. So I just go there and then buy all these books. And then it's second-hand books. So by the time you get it, it is third-hand, fourth-hand, I think. Third-hand, fourth-hand. But it is still useful. And the reason why I'm giving it away is because I'm buying the new editions, because they come out with new editions, I think every few years, then I'm buying a new edition, okay? This one, a lot of my trading guru friends, they actually recommend this book, okay? So it's still good. A little bit highlighted, hope you don't mind. This one is super good. Super good. They came out with new editions, so that's why I'm giving this edition away, but it's still super useful, okay? Ready for the quiz? Ready for the quiz? I haven't started teaching yet, so let's get into the first part, okay? Central banks and monetary policy. Okay, so what is monetary policy? Now this is what hedge fund traders look at all the time. Monetary policy involves the control of money supply by central banks in order to alter economic conditions. Okay? And it determines the cost of money, particularly borrowing and savings rate mortgages. So when it comes to interest rates, okay? The higher the interest rates, if you can't see, you can come in front and sit here, okay? The higher the interest rates, okay? Then the higher or lower the borrowing cost. Higher, okay, very good. Higher borrowing cost. And as a result, what are the implications? Businesses will not be able to borrow that much to invest into their businesses, to projects. And hence, they will spend less money, and hence, there will be less money supply flowing in the economy. Follow me so far? And higher interest rate, it affects us as consumers too. In what way? When the bank interest rates are very high, what will we do? Save more. And hence, because there's more money in the bank, we spend less, and hence there's less money supply flowing in the economy. Follow me so far? Okay? Then mortgages also the same. The higher mortgages, the more money you need to pay for the mortgages for your house, and hence you got less extra money to spend, and hence less money flowing into the economy. So if you think of it that way, it's easier for you to remember. Higher interest rate, the higher the capital inflow, okay? So means that if you look at the yields of a currency, yield, Y-I-E-L-D, yield of the currency. Okay, the higher the yield, the more likely the currency is going to go up in the long term. Because investors, they want to seek higher yields as compared to other countries. So that's why you see a lot of hedge fund managers, they conduct this trading strategy called, use this trading strategy called carry trading strategy, meaning they look at interest rate differential. So the higher the interest rate differential between two currencies, let's say Aussie and yen, the more likely it's going to go up in the long term. Okay, look at interest rate differential is very important. Next, don't fight the Fed. Don't fight the Fed. Now, if you are a value investor, to become a successful value stock investor, you need to be a contrarian. Now, recently I talked to this, where is he from? Malaysia hedge fund manager. Okay, and he consistently outperformed the market and other hedge funds. And then a lot of newspaper interview him. So what's your secret? What's your secret? What's your secret? Then he said, you know what? When the markets are very high, I would tend to sell off a portion of my stocks, so that when the market crash comes, I can buy stocks at a very cheap price. That is my secret. And why don't people do this? Because when the markets are high, everybody is making money. What do people do? They will want to put more money into the stock market. Oh, because he's making money. Why are you not making money? That's the hard part. Okay? Okay, so for the Fed particularly, the objectives of the Fed, meaning the mandate is to maintain equilibrium balance of payment, and also to ensure price stability, economic growth, and full employment. Now, understand that different central banks have different mandates let's say for ECB, they don't care so much about achieving full employment because their main objective, their main mandate is price stability. Okay, but for Fed, it is this three. Monetary policy tools. Now, if you read the finance textbooks and all that, there are a lot of tools, but I need you to just focus on three main tools, the yellow ones, okay? 1, 2, 3, influencing commercial banks to change their reserve ratio. Now, what is reserve ratio? Reserve ratio. If the Fed tells commercial banks, please increase your reserve ratio, meaning that they should keep more money in their vaults, in their bank. And as a result, there's less money flowing in the economy. Okay? And of course, changing interest rates, and then followed by open market operations. Then the rest of the tools, don't need you to focus on this right now because it requires some explanation, okay? By the way, MAS, Monetary Authority of Singapore, instead of influencing the interest rate, they influence on the currency instead, meaning Singapore dollar. They just change the value of Singapore dollar rather than interest rate. And this is going to have the same effect, more or less the same effect as the changing interest rate. Okay, so I'm sure a lot of you know this already. When a central bank is hawkish, they will want to raise interest rates and the currency is going to go up. Okay, remember, higher yields, more capital inflow into the country, into the currency, and hence price goes up. Okay, so this is called contractionary monetary policy. Okay, what is it? Contractionary monetary policy. And it's also known as tighter, restrictive, deflationary monetary policy. It involves increasing interest rates, okay? Increasing reserve requirements, selling government bonds. Now, by now, you should know this already, okay? If you don't know, it's okay. Bond prices is proportional or inversely proportional to yields. Proportional, okay, very good. Inversely proportional to yields, meaning if the Fed sells government bonds, price will go down, yields will go up or down? Up, okay, very good. Implemented in an overheating economy or fast economic growth. Alright, by reducing money supply, this policy is used to reduce inflation. Okay? Used to decrease consumption of imports and to control balance of payment. Okay, when the central bank is dovish, they will want to cut interest rate, so the currency goes down. Okay, this is what we call expansionary monetary policy. It involves cutting interest rate discount rate. All right, and it's used to stimulate the economy by encouraging spending, borrowing, investments. Central banks buy bonds in the secondary markets, which reduces the supply of bonds available and increases money supply. As commonly used in recessions or when economic conditions are very bad. Okay, what to take note of? Take note of central bank bias, meaning the current chairman. Sometimes when a chairman is elected, he would be more dovish, biased. Sometimes he or she will be more hawkish, biased. Okay, who's the current chairman of Fed? Jerome Powell. For inflationary conditions, he's normally hawkish. Okay, but on normal times, he's more neutral. Changes in bias will be priced in fast, but not immediately, like the markets are not entirely efficient. okay? Even though when you read textbook, it says market are entirely efficient, but it's not. Some central banks are influenced by politics. You can understand that central banks act on behalf of the government, okay? Can you predict interest rates? Yes or no? Yes, sir. What do you look at? Can bonds? Fed funds futures. I cannot predict the market, okay? But we trade based on probability. Meaning you look at certain indicators, like Fed funds futures. It can tell you whether the future interest rates are going to go up, go down, remain the same. Okay? Look at what? Fed funds futures. Now, how do you use Fed fund futures to so-called predict? So Fed funds futures, it gives you an early indication of Fed interest rate decisions. Now, the reason why I tell you I can't predict the market, okay? Of course, nobody can, including me. Because back in January 2020, I made a talk that I tell people the economy is going to grow this year. But then end up, in March, what happened? March 2020. What happened? COVID, okay? What were you doing during that time? What were you doing? Lockdown? So the economy went down in that period, okay? Because I couldn't predict it. But in 2023, I went on to this podcast. We had this YouTuber called Jian Hao Dan. Do you know him? How many of you know him? How many of you watch him? Okay, continue watching, okay? He do a lot of student videos, student classroom videos, which I sometimes also do. Then based on the Fed funds futures, because he asked me, so is a recession going to come this year? I said, you can go and listen to the podcast. I said no. Because Fed still has room to increase interest rates. Okay, that's what I told him. You can go and listen to this podcast. Because they asked me one question which I don't know how to answer. I can answer, but at that point in time, it's like, it's going to take one day to explain. Because he asked me this question. So how to trade? How will you answer? Okay, step 1. That is step 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. But it was a fun experience. Used by pro traders and institutions for speculation and hedging purposes, okay? And the Fed funds rate actually moves in line with discount rate, okay? Later I'll show you how to calculate Fed funds futures. Provide a clue on the long-term direction. We look at 30-day Fed funds futures graph. Okay, so let's get into that. You need to go to a trading view, or you can find other platforms that are better than trading view. But I use this one, simple. Then key in the symbol ZQ1 exclamation mark. Okay, then you get a 30-day Fed funds interest rate futures. Can you see this number? 94.690. Do a bit of math for me, okay? You take 100 minus the current number on the graph. So what's the number? Then what's the answer? What's the answer? Very good. 5.31. Now here's the thing. The moment in which this screenshot was taken, interest rate was at 5.33. Okay? Then you compare with this number. The moment the screenshot was taken, that interest rate was 5.33. Alright? Then you compare with this number. So you take whatever interest rate that is available right now today, compare with your calculated number. Understand so far? So what's the difference? 5.33 minus 5.31? 0.02, very small number. So when the difference is very small, like 0.01, 0.02, the interest rates are going to remain the same. When it's a big difference, like 0.1, then the chances of interest rates going up in the long term is going to be very high. Follow me so far? 0.01, 0.02, interest rate maintain the same. 0.1 or above, chances are interest rates are going to go up. Okay, quiz. I'm going really fast, okay, because they need me to finish by 3 p.m. 3 p.m. Okay, let's do this quiz, okay? If you know the answer, raise your hand. Which of the following statements correctly describe the mechanisms, short-term effects, long-term effects, and potential risk of expansionary monetary policy? If you know this answer, raise your hand, okay? A, expansionary monetary policy primarily involves raising. There was a Singaporean student went on an international stage. Before the question is even finished reading, he already got the answer. B, short-term effects of expansionary monetary policy include, if you are still not sure, it's okay. You can try. We are all here to learn, okay? Long-term effects. C, long-term effects of expansionary monetary policy may include increased inflation, potential for asset bubbles, and accumulation of excessive debt. First answer, D. One of potential risks of, okay, try again. So D is not the answer. C. Long-term effects, okay, very good. The answer is C. Give me a big round of applause. So which book do you want? You can actually choose the book you want, okay? This one, huh? Choose the thickest one, right? Give you a big round of applause. Actually, there's a textbook that's quite worth it and quite expensive too. Okay, so next, professional trading psychology.